Good afternoon, everyone. Welcome, and thank you for being here today. Before we start with the Monetary Policy Committee statement, I'd like to just say a few things. First of all, I'd like to pay tribute to Dillian Small. Dillian joined the bank in 1977. She's played an extraordinary role in the bank, in research, but above all in mathematics, in modeling, in establishing the modeling capacity of the bank, and has come to her retirement at the end of this month. And therefore, we want to just thank her for, and obviously we'll be doing our own internal thank you, but I think it is appropriate. This was your last MPC meeting, and it is appropriate on behalf of all the MPC members to say thank you for the extraordinary contribution you've made to the greater understanding of monetary policy, modeling, forecasting, how we deal with our understanding of the choices we make. And we'd like to say thank you to you. So congratulations on decades of service and an extraordinary achievement, Dillian. We'd also like to welcome the three young men sitting on the side there, who are here for the day. They're from Sunderland High, yes? And it's about a day in the life of a career you would like to pursue. So they've been spending a day with financial markets, and I understand they're all now very excited about being dealers and dealing in financial markets, and we hope you've had a good day with us. And we look forward to seeing you when you finish and when you study to come into the bank and work with us. And then finally, in the announcements, as you know, we have a monetary policy challenge. And for the winners this year are four young ladies sitting in the front here. Kendall Schuster, Kendall, that's you. Michelle, and Samantha, and Ntokoza. Well, the four of you come from Krugersdorp High, and your teacher, Lisa van der Schyff. I think you should be very proud. In 2012, you were the winners. In 2013, you were the runner-up. And in 2014, you're the winners again. So congratulations to you and the team. We wish you well in your studies, in your final year. And as you know, that we do offer you a full scholarship should you complete with university entrance and you choose to study economics. So good luck to all of you, and again, thank you for participating, and thank you for the school for the excellent work and the contribution and the participation that you have. So perhaps just some other issues that we are delighted to pay tribute to you, and thank you for being here today. Since the previous meeting of the Monetary Policy Committee, the economic growth outlook has deteriorated against the backdrop of protracted strike action in the mining and manufacturing sectors. The economy contracted in the first quarter of 2014, and the growth outlook for the rest of the year remains subdued amid low business confidence. Compounding the MPC's policy dilemma, inflation has breached the upper end of the target range, driven primarily by the exchange rate depreciation and rising food prices, while a possible wage price spiral resulting from recent wage settlements and wage demands, considerably in excess of inflation and productivity growth, have added to the upside risk of the inflation outlook. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, measured 6.6% in May, up from 6% and 6.1% in March and April, respectively. The main driver of this marked acceleration was food and non-alcoholic beverage price inflation, which measured 8.8% in May compared with 7% and 7.8% in the previous 2 months. This category contributed 1.3 percentage points to the headline CPI outcome, compared with a recent low of 0.5 percentage points in December 2013. The categories of food, housing, utilities, and transport together accounted for 4.2 percentage points of the inflation outcome in May, compared with 3.7 percentage points in the previous month. The transport index increased at an annual rate of 8.9%, from 6.8% in April, despite a 15-cent per litre decline in the petrol price in May. Core inflation, which excludes food, petrol and electricity remained unchanged at 5.5% for the third consecutive month. Administered price inflation, excluding petrol, was unchanged from the previous month at 6.5%. The headline producer price inflation for final manufactured goods moderated slightly from 8.8% in April to 8.7% in May, driven in part by lower agricultural product inflation. The marginal improvement in the bank's forecast of headline inflation at the previous meeting has been more or less reversed, as recent food price developments surprised on the upside. Inflation is now expected to average 6.3% in 2014, compared with 6.2% previously, with a quarterly peak of 6.6%, previously 6.5%, still expected in the fourth quarter, following a slight moderation in the third quarter. The forecast average inflation for 2015 increased to 5.9% from 5.8%, while the forecast for 2016 increased marginally to 5.6% and to 5.5% in the final quarter of that year. Inflation is still expected to return within the target band during the second quarter of 2015, provided that there are no further shocks to the system, particularly from possible higher tariff increases being granted to Eskom by NERSA from 2015. The forecast for core inflation is unchanged. This measure is expected to average 5.6% and 5.7% in 2014 and 2015 respectively, moderating to 5.5% in 2016, with the moderate upward pressure coming from the lagged effects of the exchange rate depreciation rather than evidence of strong domestic demand pressures. As before, the MPC sees the risks to the headline inflation forecast to be skewed to the upside. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research at Stellenbosch University, have remained anchored at the upper end of the target band. The average inflation expectation of analysts, business people and trade union officials for this year and next year has remained unchanged for 6 consecutive quarters at 6.1% for both years, declining to 5.9% in 2016. Within these categories, the largest change was by business people for 2016, where expectations increased from 6.2% in the previous survey to 6.4%. However, their expectation for 2015 moderated slightly. Inflation expectations of households for 2014 declined from 6.7% in the first quarter to 6.3% in the second quarter. The Reuters survey of inflation expectations of economic analysts conducted in May is more or less unchanged since the previous survey, with a slight upward shift. The outcome of the survey shows a divergence of views among analysts as to whether inflation will peak in the second or fourth quarter of 2014. On average, the expectation is for inflation to peak in the second quarter at an average of 6.4% and to return to within the target range in the first quarter of 2015. According to the survey, annual inflation is expected to average 6.2% in 2014 and 5.7% and 5.5% in the subsequent 2 years, respectively. The global economy continues to exhibit mixed signals regarding the economic growth outlook. Since the previous meeting of the MPC, consensus forecasts for growth in 2014 have been revised down for the US and the Eurozone, but those for Japan and the UK have been revised upwards. The earlier optimism that the US would grow at around 3% in 2014 has been moderated following the 2.9% annualized contraction in the first quarter, partly a result of severe weather conditions and a decline in expenditure on health care. Most analysts now expect US growth to be closer to 2%. This weaker growth is despite larger than expected improvements in the unemployment rate. The outlook for the Eurozone has also deteriorated, following weak industrial output in Germany in May and slowing growth in France and Italy. Real output in Japan is expected to contract in the second quarter, following the surge in expenditure in the first quarter in advance of the increase of consumption taxes. The UK recovery, however, appears to be sustained with growth of around 3% expected in 2014. The outlook for emerging markets remains relatively subdued, but some emerging Asian economies have benefited from stronger US growth. The Chinese economy is expected to grow just under 7.5% in 2014, although concerns about the shadow banking system remain. Subdued growth is expected in a number of emerging markets, including Brazil, Russia, Thailand, and Argentina. Global financial market developments remain dominated by expectations of changes in monetary policy in the advanced economies, amid concerns that current low interest rates and low volatility environments may encourage excessive risk-taking and asset price bubbles. By contrast to a number of emerging market economies, inflation remains benign in the advanced economies, although the risk of deflation in the Eurozone persists. The UK is expected to be the first advanced economy to raise interest rates, but at a moderate pace, while the US is generally not expected to begin the process of normalization before the third quarter of 2015. However, the tapering of bond purchases by the Fed is expected to continue at a steady pace. This process is fully discounted in the markets and is expected to be completed later this year. By contrast, the ECB has recently announced a range of new monetary policy measures aimed at stimulating the economy through encouraging bank lending and preventing deflation, while Japanese monetary policy is expected to remain highly stimulatory for some time. Since the previous meeting of the MPC, a number of countries have reduced their policy rates, including the Eurozone, Sweden, Mexico, Hungary, and Turkey, while the tightening cycle continued in New Zealand. The exchange rate of the rand continues to pose an upside risk to the inflation outlook. Having appreciated to a level of 10 Rand 29 against the dollar soon after the previous MPC meeting, the rand exchange rate followed a depreciating trend, reaching a new trading range of between 1060 and 1080 since the beginning of June. Since the previous MP meeting, the rand has depreciated by 2.6% on a trade-weighted basis. The appreciation of the rand in May was in response to more benign global factors as market participants absorbed the forward guidance provided by the central banks in the advanced economies. This contributed to lower risk aversion and renewed flows to emerging markets in general. Since the previous meeting, non-resident net purchases of bonds and equities amounted to 7.2 billion rand and 44.2 billion rand since the beginning of February. Despite these inflows, since early June, the rand has largely decoupled from its emerging market peers and depreciated relative to most currencies as it reacted to deteriorating domestic fundamentals. These included the negative GDP growth rate, the adverse reports from the rating agencies, and the protracted nature of the platinum and metal workers' strikes. The impact of the platinum sector strikes on exports began to be felt in April and May, and it is estimated that during these 2 months, the value of platinum group metals exports was around 20 billion rand lower than during the first quarter. This is likely to put pressure on the current account of the balance of payments in the second quarter, following a narrowing of the deficit in the first quarter to 4.5% of GDP. South Africa's growth outlook has deteriorated since the previous meeting of the MPC, compounded by continued labour disruptions. Following a contraction of 0.6% in the first quarter, the outlook for the second quarter is expected to be positive but subdued, particularly in the light of weak mining and manufacturing data in May. The bank's latest forecast, which assumes a speedy resolution of the metal workers' strike, sees growth in 2014 at 1.7%, compared with 2.1% previously and 2.8% at the beginning of the year. Growth forecasts for the coming 2 calendar years have been reduced to 2.9% and 3.2% from 3.1% and 3.4% respectively. The RMB BR Business Confidence Index remained low and unchanged at 41 index points in the second quarter of 2014, with a sharp decline particularly evident among manufacturers. The bank's leading indicator of economic activity declined moderately, reflecting subdued growth expectations. The weak business confidence is mirrored in the 2.6% growth in gross fixed capital formation in the first quarter of 2014. Growth in fixed investments by the private sector, which accounts for about 2/3 of gross fixed capital formation, weakened further from 2.4% in the fourth quarter of 2013 to 1% in the fourth quarter of 2013 to 1% in the first quarter of 2014. The mining sector contracted by an annualized 24.7% in the first quarter of 2014, and although mainly driven by the strike-induced decline in PGM output, the contraction was fairly broad-based across the sector. Despite a higher-than-expected performance in April, the data for May show that the outlook for the second quarter is also bleak. In May, the physical volume of mining output declined by a non-annualized 3.1% on a month-on-month basis, and by 5.6% on a three-month-to-three-month basis, with PGM output declining by 34.1%. While the strike is over and miners are returning to work, PGM production is not expected to normalize for some time, and possible shaft closures could reduce the longer-term potential of the sector. The manufacturing sector performance in the first 2 months of the second quarter has also been disappointing, following the 4.4% contraction in the first quarter. In May, manufacturing output declined by 3.7% on a year-on-year basis and by 2% on a three-month-on-three-month basis. The sector was negatively impacted by electricity supply constraints and the platinum sector strike, while the current strike by metal workers is likely to undermine the outlook for the third quarter. The Kagiso PMI registered a slight improvement in June, measuring 46.6 index points, but has remained below the neutral 50 index point level for 3 consecutive months. Trends in employment growth are indicative of the weak private sector investment. Although formal non-agricultural employment increased for the third consecutive quarter in the first quarter of 2014, all the gains were in the public sector. While overall employment increased by 42,000 jobs in the year to the end of March, 49,000 jobs were created in the public sector, while the private sector shed jobs, particularly in the mining sector, where almost 29,000 jobs were lost. Final consumption expenditure by households remains the main driver of GDP growth, but with a declining contribution of 1.2 percentage points in the first quarter of 2014. Growth in household consumption expenditure, which measured 2.6% in 2013, declined to 1.8% in the first quarter of 2014, with a marked moderation in the growth of expenditure on durable goods and a contraction in spending on non-durable goods. Retail sales growth contracted by 0.8% on a three-month-to-three-month basis in May and increased at a month-on-month rate of 0.8%. Domestic motor vehicle sales declined by 2.3% on a year-on-year basis, but increased by 4.7% on a month-to-month basis in June. Despite these weak trends, consumer confidence surprised on the upside in the second quarter, with the FNB BER Consumer Confidence Index increasing from -6 to 4 index points, although respondents do not deem the present time as appropriate to buy durable goods. Growth over 12 months in total loans and advances to the private sector measured 8.2% in May 2014, but the divergent trends in bank credit extended to households and the corporate sector have continued. Growth in credit extended to the corporate sector has been steadily increasing since the beginning of the year, measuring 13.3% in May, due in part to renewable energy contracts. By contrast, growth in credit extension to the private sector has continued to trend downwards to measure 4.3% in May. 12-month growth in general loans to households, mainly unsecured lending, declined to 2.8% in May, its lowest growth since February 2005. Mortgage credit extension remained within the 2 to 3% range observed since January 2013, and installment sale credit and leasing finance also continued to moderate, from growth rates of around 13% in the second half of 2013 to 8.6% in May. These credit extension trends to households reflect a combination of weakening household consumption expenditure and stricter bank lending criteria for unsecured loans in particular. Household debt to disposable income remains elevated, but declined marginally to 74.5% in the first quarter of 2014. The trend in wage settlements pose an upside risk to the inflation outlook, and these pressures are likely to intensify in the current difficult labor relations environment. According to Andrew Levy Employment Publications, the average wage settlement rate in collective bargaining agreements increased from 7.9% in the first quarter of 2014 to 8.1% in the second quarter. However, Increases over 4 quarters in nominal unit labour costs in the formal non-agricultural sector declined from 5.9% in the fourth quarter of 2013 to 4.8% in the first quarter of 2014. The MPC is concerned that recent wage settlements in the mining sector and current demands in the metal sector could set a precedent for wage demands more generally. Unless accompanied by higher productivity, such settlements could generate a wage price spiral and are also likely to have a negative impact on employment trends. While the focus has generally been on wage demands, there is an imperative for attention to also be paid to excessive salaries and bonuses of management and executives. Food prices have been one of the main drivers of inflation since the beginning of the year and have generally surprised on the upside in recent months. There are, however, some tentative indications that we may be near the peak. In May, manufactured food producer price inflation moderated for the first time since October 2013 and measured 8.9%, down from 9.5% in April. Agricultural producer price inflation declined from a recent peak of 13.3% in March to 6.7% in May, reflecting in part the sharp decline in maize prices to export parity price levels. Prices of cereals and other crops declined by 0.8% in May, having reached a recent peak of 27.6% in February. Global food price pressures are also benign, with the year-on-year inflation rates as reflected in the FAO Food Price Index being negative for 12 consecutive months. Apart from weather-related risks, the overall trend in food prices will remain highly sensitive to exchange rate developments. Despite recent geopolitical risks, particularly in the Ukraine and Iraq, international oil prices have remained relatively stable. Apart from a brief spike to a level of around $115 per barrel in June, the price of Brent crude oil has generally traded in a range of $105 to $110 per barrel, and is currently at around $105 per barrel. Domestic petrol prices have therefore been driven primarily by exchange rate changes. Following the appreciation of the rand in April, the petrol price was reduced by a total of 37 cents per litre in May and June, but this was largely reversed in July when the price increased by 31 cents per litre. Should current trends persist, a further small increase in the petrol price can be expected in August. The MPC remains concerned about weak growth, widening output gap, and the negative employment outlook. The strike in the platinum sector contributed to the downward revision of the growth forecast, and the latest forecast has not factored in the possibility of a protracted work stoppage by the metal workers, which would potentially have much wider ramifications because of the direct linkages to other sectors of the economy. This weak growth outlook, however, is not something that monetary policy can ameliorate. The MPC is also increasingly concerned about the inflation outlook and the further upside risks to the forecast. Although the exchange rate remains a key factor in this regard, the possibility of a wage price spiral should wage settlements well in excess of inflation and productivity growth become an economy-wide norm has increased. Although the inflation trajectory has not deteriorated markedly since the previous meeting, upside risks have increased, and it is expected to remain uncomfortably close to the upper end of the target range when it eventually does return to within the target. The upside risk factors make this trajectory highly vulnerable to any significant changes in inflationary pressures. Although inflation expectations have remained relatively anchored, should inflation persist outside the target band, these expectations risk becoming dislodged. The MPC is, however, cognizant of the fact that the inflation pressures do not reflect excess demand conditions in the economy. Household consumption expenditure remains weak, and credit extension to households is contracting in real terms. However, we do have to be mindful of second-round effects of supply-side shocks. The MPC faces an increasingly difficult dilemma of rising inflation and slowing growth. The core mandate of the bank remains price stability. But at the same time, in achieving this mandate, we have to be mindful of the impact of our actions on economic growth and tread a fine line between acting effectively to address the inflation objective while not undermining growth unduly. The MPC has decided to continue on its gradual normalization path and raise the repo rate by 25 basis points, to 5.75% per annum, effective from Friday, 18th of July. Given the expected inflation trajectory, the real repo rate remains slightly negative and well below its longer-term neutral level. The monetary policy stance remains supportive of the domestic economy, and, as before, any future moves will be gradual and highly data-dependent. We would like to reiterate that monetary policy should not be seen as the growth engine of the economy. The sources of the below-par growth performance are largely outside the realms of monetary policy. In the short term, an improvement in the interaction and relationships between management and labour is essential to foster a climate of trust and confidence and get South Africa back to work. Given that the key headwinds preventing a return to trend growth are structural, there is an urgent need to implement necessary structural reforms as envisaged in the National Development Plan in order to achieve higher and more inclusive growth. Thank you. Questions? Miriam, your usual.
I think more than that.
Okay.
Okay. What was the split of votes in the MPC? And it was kind of strange that since January, the MPC has been emphasizing that we're in a rate hiking cycle. And obviously you've just raised rates again, but there's been no mention of this. Does that mean this could be the last interest rate hike? What should we read into that?
I think you're not reading correctly, Miriam. Let me just come back to here. Top of
14.
page 4. Well, yours might be different, but it's also in the concluding. The monetary policy stance remains supportive of the domestic economy, and as before, any future moves will be gradual and highly data dependent. We have said repeatedly, and we would repeat, that we are in a rate hiking cycle, but the hiking cycle is something that we've said all the time will be data dependent, it will be gradual, because of this very dilemma that we face about addressing both rising inflation and slowing growth. So it would be an incorrect reading of it, but if you've got the top of page 14, mine would be different. Just read what's there, Kuban.
Thank you, Governor. The top of page 14 on mines, I don't know what it'll be on yours, is the MPC has decided to continue on its gradual normalization path and raise the repurchase rate by 25 basis points to 5.75% per annum, effective from Friday, 18 July, which suggests it's part of a cycle.
Okay.
Okay, what about split?
No, I'm coming to that. I wanted to deal with your split. You're so worried about that. First of all, I want to reiterate that, in fact, there is a very strong common understanding of what the issues are. There's no difference in the MPC about the challenge we face, the dilemma we face of rising rising inflation and slowing growth. That we all understand and appreciate. The challenge about it is what the balance is. And the vote, we don't vote, as I said, the decisions that we have was 6-1, with one person saying hold, one person saying 50 basis points, a strong, I would say, a reasonable discussion about 50 basis points versus 25. We have looked very carefully at the impact of 50 and 25, whether you front load, whether you do it later, what the impact would be if you don't raise now, what the impact would be, would you have to do more later, and so on. So there's a lot of discussion around that. But one person firmly saying 50 basis points and the rest saying 25 basis points. So 6-1 really, and then a difference of 1 in terms of 50 or 25. Okay. Yes, sir.
Yeah, Governor Ed Stoddard with Reuters. You've reduced your growth forecast once again. I'm just wondering what your kind of general sense is right now. Do you feel that the economy might actually be in recession right now?
You know, the question for me about recession, I don't think so. It depends obviously on what happens, and the numbers are not good. But as I've said before, if you go into a consecutive quarter of negative growth, you'd be technically in a recession. The challenge for us is that your second quarter, even if you're not in recession, is very low. And therefore, for us, the challenge is what do you do to ensure that you get growth and inclusive growth and a growth that actually would be employment generating as well. So for me, it's much more the focus on what you need to do to ensure that we stimulate growth, rather than saying, are we in a recession or not? I don't know. The numbers will come out for the full quarter. The numbers are not good. We don't think so. And we've said before, we don't think we're in a recession. But whether we are or not, the challenge is that you've got very, very low growth, and you need to act in a concerted manner to address that question as a country. Renee?
Good afternoon, Governor. It's Renee Volgra from Bloomberg. Governor, a 25 basis point hike, I mean, this hasn't been done since the early 2000s. What difference will a 25 basis point increase really make? I mean, what do you hope to achieve by that? Is that going to curb demand in the economy at all?
We were looking, just who would like to deal with that? All of you, you can all have a go. Go on.
Just briefly, Renee, the issue is that currently the repo rate is 550 basis points. And so if you take 25 basis points over 550 basis points as a percentage, it's quite significant. I think it's in the vicinity of 4.5%. So I think that if you look at 25 basis point and the repo rate had to be 15%, of course, the effect is far more insignificant. And I think the reality of it is that repo rates are at historical low levels. And so therefore, I do think that it does have a more pronounced effect vis-a-vis if the adjustment started at a higher repo interest rate level.
You want to add, Kuben?
Thank you, Governor. A small addition. I guess 25 basis points on its own has a minimal impact, but seeing in the context of what we did in January and what we're likely to do over the next 2 or 3 years, all of that has to be looked at as having an impact on the inflation trajectory.
Any other questions? And let's first see if there's anyone else. Anyone? Miriam?
Thank you. You really reduced your growth forecast quite sharply, and we still can't say we're going towards a recession. But the NUMSA strike is continuing. What are the risks to your growth outlook if this strike carries on much longer?
Rashad, you want to deal with that? I'll add if you want, but let's see what you say.
Look, Miriam, obviously, we haven't taken into consideration the actual impact of the NUMSA strike, and we'll have to see, how it pans out. But the important thing is that the current forecast doesn't incorporate the strike in as far as foregone salaries and wages of workers depending on the strike, supply disruptions depending on the extent to which the disruptions happen in the metal sector, how much of it happened in sectors that are linked, both forward and backward linkages and so on. So obviously, once we have a better sense of this, and we probably would have a better sense of this as we go into the September MPC, we obviously would be factoring that into our forecast. But it's very difficult to pin down a magnitude to it now because, a lot of parameters are kind of not clear to us. But the important point that we're signaling is that, there's a downside risk to growth, and this depends on how long and protracted the strike is and all the kind of effects that come from a strike.
But you could get some indication of impact if you looked at the mining strike and the fact that although that lasted 5 months, it was on a much smaller sector than NUMSA would be, and that impacted 2.2% on, perhaps just deal with
that. What we did in the quarterly bulletin is we did an exercise to say that, the economy contracted by minus 0.6%, contracted by 0.6% in the first quarter. If you do an exercise that looks at both the direct and indirect effects of the platinum strike, the economy would have grown by about 1.6%. That's kind of a broad orders of magnitude, but it gives you a sense of the impact, foregone production, foregone salaries and wages can have in a quarter.
And that is a table in the quarterly bulletin if you wanted to look at it. Sorry, you want to add, Dan? Sure.
A quick point as well. If you look at the statement, it indicates that the forecast, as it stands at the moment, having been reduced, assumes a speedy recovery of the strike. So that gives you the downside.
Yeah,
sort of
our
risk.
forecast does not include duration of strike or potentials from that. It assumes that the strike is resolved. Yes, sir.
Hi, Governor. TJ Sturdham from the Times. Firstly, I just lost 100 Rand in a bet because of you, Governor.
Hey, you bet small, hey?
And secondly, is there a magic number for wage increases? Is there a number where you're comfortable, or the MPC is comfortable with wage increases sitting at?
No, I don't. We're not looking at the number to say this is a good number and that's a bad number. Obviously, you've got an inflation target band between 3 to 6, and any wage settlements above that affect. But it really is not just the absolute level of wages. It's the level of productivity that would be, in our sense. You can have very high wages if your productivity exceeds your wages. So it's not about a level. What we are saying is that if you're making demands or refusing or rejecting settlements at 10%, does 10% become the norm of what you ask for? And if you've got a 10% wage settlement, does that not create a wage price spiral, or has the risk of creating a wage price spiral? That's the one side of the equation. The other side of the equation is what's happening to executive pay and management pay and bonuses and what is being received there. And we're saying that while there's a lot of attention paid, quite rightly, to what's happening in terms of labor, what is also happening among executives and management needs to be looked at. It's quite unacceptable. So it's not as if there's only one side to this equation. So no, there isn't a level that's right. Obviously, it should be guided by the question of what is your real increase, what is the inflation target, what is inflation, because that, of course, if you have high inflation, which is precisely why we act against it, or try to contain the inflation, because that's got to drive demands higher. So contain inflation so that the real value of the rand in your pocket is maintained. And that obviously affects low-income workers or unemployed more.
Can I just do a follow-up on that?
Sure.
Who then looks at something like executive pay?
You guys should be all looking at that.
We are looking at it quite often.
And ensure that you do actually vigorously look at what is being set by the remuneration boards, the committees of the boards, and what is acceptable and the differences between it, and to look at that there is a balance. And part of that balance must be the relations in the re-establishing sound working relations between employer and employee, where the employee has a sound understanding and appreciation of the conditions of the companies, the profitability of the sector, what is happening in the industry. But employers know their workforce, know what's happening, and are actually committed to being part of resolving this untenable situation, which includes looking at their pay. Okay. You know, because a remuneration committee of a board recommends an increase, doesn't mean you have to take it. It's not obligatory. They shouldn't be recommending the levels they do, but you also don't have to take it. You know, you do exercise will. Renee?
Thank you, Governor. Governor, I see the rand has weakened somewhat after the announcement. I'm still on the 25 basis point issue. I mean, is that enough to maintain the credibility of the Reserve Bank? I mean, given that the market don't seem like too happy with the move.
I can't comment by what you're saying about that. First of all, the rand moves in its own directions, as you know. When people expect it to go up, it quite often goes down, and the other way round. I think the bank is credible. I think that we certainly, in our view, are consistent in what we're trying to do to see through the noise. And because you've got an instantaneous reaction on one direction doesn't address or remove the credibility of the bank. I think the question of credible policy is something that is considered, that is consistent, that is not a surprise, that addresses the very difficult challenges we face. And that's what we try to do. So, yeah, I mean, the rand moves. We don't know what was priced in before either, as to what expectations were. So the rand moves. That's what it does. That's why it's a currency that is, it's a very open economy with the rand used as a proxy for many other markets. So I think that if you looked at the credibility, Renee, I would ask you to assess your own sense of credibility rather than saying that a move of the rand in this direction reflects credibility otherwise. Other questions? Anyone would like to comment? You all done? Okay. Candy?
Governor, from the webcast, Peter Montalto.
Hey, Peter, can you hear us?
Last time you talked more about expectations around the Fed normalization moving out. How do you see that story developing still the end of the year?
I would say to that you've just had 2 days of testimony by Janet Yellen, who has answered questions over that reflected that raised all these issues. I think she answered the questions very extensively. I don't think there's much to add. What we have said is that the pressures of normalization, given and the Fed has been very cautious about it, given, as she put it, serious headwinds in the economic recovery. We've seen the numbers for the first quarter. We'll see what the rebound is on the second quarter. And that the question that there will be normalization, yes, as to when it will happen. I think there are 2 important points here. Tapering is continuing and will conclude, probably around October, November, and therefore one element of that normalization is put to bed. The second question of when interest rates would rise is something that they will determine based on the indications from their own economy. Obviously, it matters to us because we need to look at what the impact will be, and we watch it carefully. But I think that she has set out as clearly as possible their thinking on interest rate normalization. I don't know if you'd like to. Anything else from anyone? If not, thank you all very much. Thank you for being here. Thank you very much to our MPC Challenge winners and our visitors for the day. We look forward to ongoing interactions with all of you, and we will see you in September. And maybe by then, we've actually got a clearer picture of what is happening on some of these issues. Thank you all very much indeed.